Ladies and gentlemen, good day and welcome to Rossari Biotech Limited's earnings Concall. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you.
Thank you. Good evening, everyone, and thank you for joining us on Rossari Biotech Limited's Q4 and FY25 earnings conference call. We have with us Mr. Edward Menezes, Promoter and Executive Chairman, Mr. Sunil Chari, Promoter and Managing Director, and Mr. Ketan Sablo, Group Chief Financial Officer of the company. We'll begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Edward Menezes to make his opening remarks.
Thank you, Mr. Anup. Good evening, everyone, and thank you for joining us on our earnings conference call. It's a pleasure to have you with us as we discuss our operational and financial performance. We concluded FY25 with a steady performance, navigating a soft and evolving operating environment. Despite external challenges, we delivered healthy growth and maintained stable profitability, reinforcing the strength of our diversified business model. Our HPPC division continued to lead our growth, supported by deeper market penetration and strong traction across agrochemicals, personal care, and institutional business. The TSC division remained stable despite ongoing pricing pressures in the textile industry, while the AHN business showed encouraging signs of recovery, backed by focused portfolio realignment initiatives. At Rossari, R&D remains central to our growth strategy. Through continuous innovation, we continue to develop tailored high-performance solutions aligned with evolving market needs. A key highlight is Reneva, our in-house biosurfactant platform. Designed with sustainability at its core, Reneva offers health, safety, and environmental benefits while enhancing application efficiency. Its adaptability makes it relevant across more than 10 industries, underlining our capability to deliver cross-sectorial impact through green chemistry. On the manufacturing front, we are executing multiple expansion projects to prepare for the next phase of growth. The previously announced expansions at Dahej and Unitop are progressing as per the revised plan, with commissioning expected by Q4FY25. In addition, we are pleased to announce further investments with an additional capex of 97 crores for expansion at our subsidiaries Unitop Chemicals and Tristar Intermediates, and rupees 95 crores at Rossari Biotech. These projects, which are expected to be commissioned in a phased manner by Q4FY26, are aimed at supporting growth across key chemistries, improving operational efficiency, and enhancing supply reliability. Together, these investments reinforce our commitment to building a scalable, future-ready platform to drive the next phase of growth. With a strong R&D engine, expanding capacities, and a growing global footprint, Rossari is well positioned to lead in delivering high-performance, sustainable solutions across industries. As we move forward, our focus remains on anticipating evolving customer needs, deepening our technological and operational capabilities, and building a future-ready organization. With this, I now invite Mr. Sunil Chari to share his thoughts.
Thank you, Edward G, and a warm namaste to everyone. Our performance in financial year 2025 underscores the resilience of our diversified business model, with overall revenue growth of 13.6%, reflecting the strength of both our core and emerging businesses. We are particularly encouraged by the tractions in new verticals such as institutional cleaning and B2C businesses. These have now scaled meaningfully. And starting this quarter, we are showcasing them as a distinct vertical in our earnings presentation. This business has delivered strong growth of 67%, reaching almost 300 crores in revenue for FY25. Leveraging cutting-edge technology, deep expertise, and a strong network, we are shaping the future of this consumer health and hygiene vertical. A business that, while requiring a long gestation period, holds immense strategic value through consumer trust and brand equity. While the scaling up of these emerging verticals has had a near-term impact on consolidated margins, our core business continues to deliver healthy profitability with an adjusted EBITDA range of approximately 15% for financial year 25. We view these investments as critical to building future-ready, scalable platforms. As these new businesses achieve greater scale and operating leverage, we are confident that they will drive margin expansion and enhance long-term shareholder value. These verticals underscore our ability to anticipate evolving customer needs and create differentiated value-added solutions aligned with future growth opportunities. Our global business also recorded a strong year, with exports growing by 27% and our presence expanding to over 70 countries. This growth reflects our focused efforts on cultivating strategic markets, deepening customer relationships, and delivering innovation-led customized solutions anchored by strong technical expertise. Participation in leading global forums continues to strengthen our international footprint and position us at the forefront of green solutions. With rising global interest in sustainable chemistry, we are optimistic about the long-term growth potential of this business. With a strong foundation in place, we are confident in our ability to unlock new opportunities and deliver differentiated, sustainable solutions across industries. Our growth investments, whether in capacity expansion, new verticals, or innovations, are a testament to our future-focused strategy. As these initiatives scale, we are confident that they will generate strong returns and create lasting value for our stakeholders. We remain deeply committed to profitable growth and shareholder value creation as we embark on the next phase of our journey. We thank you for your continued support, and I would now request Ketanji to share his perspectives.
Thank you, Mr. Chari, and good evening, everyone. Let me provide you with a brief overview of the financial performance for the quarter and the full year ended March 31st, 2025. Q4FY25, our revenue from operations grew by 22.6% YOY to rupees 579.6 crores, reflecting a continued strength of our diversified portfolio. EBITDA for the quarter improved by 9.3% YOY to rupees 69.5 crore with an EBITDA margin of 12% compared to 13.5% in the same period last year. For the full year FY25, we crossed the 2,000 crore milestone with revenue from operations reaching rupees 2,080 crores, up 13.6% YOY. EBITDA increased by 6.1% to 265.1 crore with an EBITDA margin of 12.7% compared to 13.6% in FY24. Despite the muted external environment, our performance demonstrates the resilience of our operating model and the strength of our core segments. Our institutional and B2C business delivered strong momentum, growing by 67% YOY to reach 299 crore in FY25. As these businesses have now reached a meaningful scale and being more consumer focused, we have decided to showcase them separately starting this quarter. We are confident that they will continue to scale meaningfully in the years ahead. It is important to note that ongoing investments in new business verticals have impacted reporting margins. However, profitability in our core business remains robust. Adjusted for institutional and B2C business, Rossari Biotech's consolidated EBITDA margins stood healthy at 15%, reflecting the strength of our base business fundamentals. Expenses have gone up during the year. Much of these is in line with our growth initiatives, planned expansions, and some businesses being in their growth phase. We remain confident that as these initiatives achieve scale and reach operational maturity, they will contribute to margin improvement in the future. During the year, we continued to invest strategically to build future-ready capabilities. The board has approved a total capex of approximately 192 crores, covering expansions at our sites. These projects, expected to be commissioned in a phased manner by Q4 of FY26, are aimed at strengthening our production capabilities, enhancing supply reliability, and supporting scalable and sustainable growth. On the working capital front, we have improved slightly by 2 days compared to last year. Inventory levels increased. This is in line with our strategy to build stocks in March 2025 ahead of the upcoming agro season and a planned supplier shutdown. Receivables have come down by 2 days, and we are targeting to further improvements through FY26. We are taking proactive steps to streamline working capital across businesses and will continue to monitor this closely. Our balance sheet remains healthy with strong liquidity and comfortable leverage levels. Additionally, the board has recommended a dividend of rupees 0.5 per share for FY25. As we move into FY26, our focus will be on executing growth initiatives with discipline, improving margins as operating leverage builds up, and driving sustainable, profitable growth to create long-term stakeholder value. On this note, I conclude my opening remarks and request the moderator to open the forum for questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the opportunity, and thanks for sharing the separate data for institutional business. I hope it continues on a quarterly basis. Just one more suggestion. Now, since we have bifurcated the HPC business, if you can also share the HPC non-agro and agro bifurcation, I think that would also be really helpful in terms of understanding the dynamics of the business on a quarterly basis. So that's just one suggestion before I go on for the first question. So the first question is in terms of the capex that we have announced, the 192 crores for both Unitop as well as for Rossari. And we are currently in phase of the execution of the earlier capex. So what has changed in terms of visibility to go ahead before completing the earlier phase of capex and to go with a new phase of capex in the same facility? So if you can give a broader picture, how do we foresee the implications of the capex over the next 3-4 years? It will be great. Thank you.
So, Rohit, thanks for the question. First, on the capex, the current capex that is going on, that's more on the ethoxylation capacity expansion that we are doing. That is expected to come on stream by Q2 of FY26. And these capexes, the current capexes which we have announced, they are a mix of new initiatives and some new products, again, of course, in our key core chemistry, but these are phased out over the full year. So most of these will probably be completed towards the end of the financial year, and then they will we'll start seeing some numbers from these in the following year. To give you a brief on what these CapEx are, I think I'll ask Mr. Chari to just give you a brief on what the products are.
The focus on the new expansion is practically non-EO because EO got delayed, from Reliance. But we are expecting, usage of the new EO facilities, including MDA, to start in the next quarter. Our loop reactor also will be fully functional in the next quarter. And the new expansion is for non-EO products, which are already raw materials which we procure from outside, which includes esters and a lot of monomers which we buy from outside. We would like to backward integrate. And there are a couple of new chemistries which we are trying to explore in the mellitic space. Last year, Rossari, we did practically very little capex, and as you know, Rossari, we are at zero term loan and zero CC, status. In fact, we have cash on the balance sheet as on 31st March 2025. And similarly, Unitop, we had planned for a bigger expansion. We did about, I think, 95 crores, which we invested in Unitop. And so we see, simultaneously both these expansions to give good revenues in the coming financial year.
So just one clarification. Earlier for the ongoing capex, we had said that 3.5 to 4x asset turns. For this new capex, including the backward integration, what could be the asset turns that can be looked at?
Around 2 to 3 should be, because there's backward integration, so around 2 to 3 should not be an issue.
Fair enough. So the second question, in terms of the HPC segment. So last year we have seen a single-digit growth, excluding the institutional business. How are we looking at in FY26, and what could be the potential areas of growth to take it to a double digit? Thank you.
So as you know, we had limitations on availability of ethylene oxide in the last financial year, and we continue to think that we should get the new EO expansion at Reliance, from which where we'll get our EO soon. The only reason for whatever growth we had, growth limitations were because of ethylene oxide availability.
Okay, and so this year, at least for the first half, again, that challenge would continue. So probably for this year also, we may have just touching the double digit or maybe higher single digit growth on HPC.
I think
so Rohit, this year we are already in discussion with Reliance. They have promised us higher availability of EO. So my take is that for the ethoxylates part in the HPPC business, we should see a low single digit, low double digit kind of growth, so around 10% or something. But there are a lot of non-EO initiatives that we have worked through the last year. I think some of them we'll see some bit of that execution start happening now in the current year. So I think we are optimistic that some of these new non-EO products that our R&D has worked out, we should see some traction of that in the current year. So we should see an overall a low double digit to a mid-teens kind of a growth in the HPPC business.
Yeah, that's helpful. Thanks a lot. All the best, and I'll come back to you.
Thank you so much.
Thank you. We'll take our next question from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I hope I'm audible.
Yes, Ankur.
Yeah. Sir, so, a couple of questions. So, one on the margin front. So if I look at the annual numbers, the standalone business and the subsidiaries, and, since you have mentioned Brazil numbers separately, So looking at all the three, margin profiles there and seeking your outlook. So on the standalone side, while I understand the capacities are slightly underutilized, broadly, these are the margins level that one should, take into consideration going ahead?
Yes. So, shown off the consumer business, I think we should be in this range of 14.5 to 15%.
Sure. And this is, obviously considering an early double-digit sort of a growth in the HPP business. And will that also imply a similar growth rate for the overall standalone business, or standalone could be slower because of the other segments being not as much on the higher side?
Yeah, but overall, also we expect the business to grow at least at the mid-teens level.
Okay, great. On the Brazil side, while the scale, the ramp up that we have seen in the business is pretty impressive, but I'm slightly, taken aback by the margins over there. So, till last year, at around 180 odd crores, we are still making a positive EBITDA, but with an incremental revenue of 120 crores, the overall EBITDA has turned negative. If you can help us better understand, this math.
So, Ankur, we are still in the process of, investing in this business in terms of manpower, expenses, selling, distribution, setting up network, distributors, etc. So, currently, it would be better if we look at this business more on the amount of revenues we can generate from it. So I think it's not proper to read it in a manner that 124 crores of additional sales have brought in 10 crores of dip in the EBITDA. This business has to reach a certain bit of scale for the EBITDAs to start showing a positive number on a continuous basis year on year. Our objective, the primary objective now is to keep growing this business, and FY26, we hope that this business on an overall basis, the institutional and the consumer business, will start showing some positive EBITDA on an annualized basis. We should see some low single digit kind of an EBITDA number for FY26.
Sure, Ketan. Just on the gross margin front, if you can broadly, suggest how has been the performance for Brazil for this year and for last year?
So gross margins overall have been in the range of 26 to 27%. It's been the same range for this year as well as the last year.
Okay, great. And just last bit, the capex breakup that you highlighted. What will be the broad spend on the backward integration, and what could be for the front end, products? And just related question there, the products that we are looking at, these are new products or increase in capacity for the existing ones?
No, Namaste Ankur ji, मैं चारी बोल रहा हूँ. In terms of this,
thanks.
Which we are planning for in the new expansion, but also go as sales, to our various customers. So this would be all derivatives which we know we have been making in small quantities, or there will be some new products. I cannot give you a bifurcation of exactly how much quantity will go into, in-house formulations or in-house reaction products of Rossari and Unitop, but there would be a synergy where there is a lot of products which will go into our own production. And there are some certain new chemistries which we are targeting this year, and this includes the trimellitic anhydride and certain new chemistries which we are there. And the last 1 year, we have strengthened our R&D, by nearly 3 times the number of people we have added in R&D. And these have, come up with a lot of new products which we are trying to go into areas which we know. So for areas which we know is home and personal care, areas which we know is oil and gas, area which we know is pharma, agro, and paints and coatings, and of course the textile industry. So we will add these new capacities to get into products which have been developed in the R&D in the next 12 months.
That's helpful, Charji. Thanks a lot for the reply. Thank you and all the best.
Thank you, Puji.
Thank you. We'll take our next question from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good evening, sir. Thanks for taking my questions. First, on understanding this institutional and B2C, when you say B2C...
Could you be a little louder, please?
Is it good now?
Yes, sir.
Okay, thank you. First question is understanding this breakup of institutional and B2C. When you say B2C, what does it really constitute?
So when we say B2C, it constitutes our pet care business, which is a direct consumer, and there are some businesses which we have started seeding now, which also go in directly in the consumer side in terms of aluminum foil, some tissues and things like that.
Okay. These are largely trading businesses, right?
No. These are not trading. We started manufacturing. Pet care is a completely in-house manufactured.
Pet care I understand, but tissues, aluminum foil, we do manufacture even them.
When we started off, we started seeding the market more as trading, but over the last year, we have set up our own small setup for tissues and all, and we are also getting some part of it, getting job work done. So kind of a toll manufacturing. But our plan is that over the next year, I mean the current year, we will try to move most of it into an in-house kind of production facility.
But these are not chemicals, right? These are more consumer products.
Yeah, these are more consumer products, but many of them actually go into our institutions also. So along with our institution chemicals, a lot of these ancillary products like tissues and foils also go into those institutions. So partly they go into the institutions and partly we are also trying to brand them and put it in the market.
Sanjay ji, to add here, I'm Chari here, to add to what Kiran sir said.
Yes,
the institutional business, our major competitors are companies like Ecolab and Diversey. And these Ecolab and Diversey, when they go to a consumer, for example, we go to a 5-star hotel, and they need to be a one-stop shop. So that made us, get into these allied businesses. So which includes, hygiene chemicals, so which includes disinfectants, which includes hand washes, floor cleaners, carpet cleaners, but also it includes tissues because wipes and tissues are integral part of hygiene, health and hygiene platform. And then the foil business came to it. And when we saw the foil business which come to it, we saw, without investing too much, we could, scale this up. And this is scaled up very well. The pet business is something which we are, looking at. And in the last 1 year, if you see, our gross margins on the console front have improved over the previous year. We have had EBITDA, which is the highest in our history. Our total sales, Sanjay ji, has been the highest in the history. And even our adjusted EBITDA for the B2B businesses, which is our core business, has been nearly 15%. So we see, when we go to a customer like a Taj Hotel or ITC Hotel or a Marriott or a Hyatt or a Hilton, we need to be a one-stop shop, otherwise they will not entertain us. The second part also is when we talk as discounts, all this in a whole, the discounts are counted by the customer. They do not look at only chemicals discount. And this is from one of the biggest Indian hotel chains in India. They ask us to do all together. They will not entertain us only for the chemical business. The hospital disinfectant business is also scaling up well there. And we see a good scope, for products which go into hospital and which these are produced by big multinational companies like 3M and Board Chemi, which is like Sterilium. And the amount of healthcare which is there, which is growing in the country, we see, together as a full basket which could go together.
No, I appreciate that, but I still don't understand the logic for going with these things for B2C. B2B, I get your point. It's a portfolio that we are trying to sell. But in B2C, what are we trying to do there?
So the pet care is something which we said we have been.
No, pet care was since the IPO time. I understand that was a very good proposition we had. But tissues and aluminum foil, that's a company.
If you go to a Reliance Retail today or a Lulu, you will see our Freshie now in this. So these are in the same machines. These are going, and because we don't have to create any additional manufacturing infrastructure, we have to fill up the machines. This is what is done, and we see a good future for creating these consumer businesses.
Got it. Next on the cost side, the inflation looks way too steep, capping any operating leverage in the business. The employee cost on a YOY basis is up 42% and other expenses are up 59%. Can you help us understand which are the cost line items is seeing such a steep inflation? Because I think we haven't added any capacity to that extent. The utility cost would be capped, which is a major cost. What is driving a 42% growth in employee cost and a 59% growth in other expenses?
Yeah, so overall, the productions have gone up, the overall sales has gone up. I'm talking about a full year kind of scenario. So the costs in terms of freight, etc., have gone up. There's a lot of expenses we've done on the sales side in terms of selling expenses. The travel has gone up significantly. So you see in the last 2 years, when I say 2 years, I mean FY24 and 23, for reasons of business not really scaling up the way we would have liked it. We were very, very cost conscious. We did not really go all out in terms of expensing for our products, businesses getting into new geographies and things like that. Last year we've been a little aggressive in terms of going into new markets, doing a little more expense in terms of travel, in terms of exhibitions, which we were not doing. And if you see our over terms in terms of number of people, the headcount has gone up roughly by about between the 2 years by about 145 people. There have been increases in the consumer business. The major increases have happened there. But even in the core businesses, we have added a lot of people on the sales side as well as in the R&D, about which Mr. Chari just spoke. We have added R&D centers at TriStar at their site, and we've also brought in few more R&D people at the Dahej facility. Currently, we are also looking at scaling up the R&D in Mumbai. So we've brought in a few more senior people on the R&D side who will be working out of Mumbai. So that facility should be coming later this year. So these are a few of the areas where the expenses have gone up. So yeah, while the increase, as I said, has been a little steep, but then it's a mix of future growth initiatives, our expansions, and of course some businesses like consumer which are on the growth phase, where the expenses have been a little more steeper.
One should assume that this should peak out in terms of growth, right? Next year, the cost line inflation.
So my take is that the current quarterly run rate, we should be around that for the next year. So employee cost, my expectation is that we will be at that 35 crore kind of a run rate. And the other expenses should be around 65 plus minus per quarter.
Got it. Because what we are missing is that though revenue is coming, gross profit is also coming, but that's not translating into EBITDA, right?
Yeah.
It appears that we are not translating the gross profit into EBITDA, or this gross profit is coming at a significantly higher cost.
Yeah, so as I said, some of these costs have been a little upfront. If you see shown off the BRPL and the PET business, I think the core business has done pretty well. The costs have not really gone up significantly there if you take those numbers out. But having said that, I think your point is well taken. We have spent a lot in this year. Much of this, I think we should see the paybacks of these ROIs coming up in FY26.
So in FY26, what are we looking in margin? Should we again hit back that 13% run rate, because we are now fallen to 12?
Yes. So of the core business, as I said, we are targeting 14.5 to 15% the EBITDA margins.
No, but on overall company basis, because 2 quarters back in 2Q, we were doing consistently 13.5%.
So we should be, yes. So as of now, our take is that the way the consumer BRBL business is also parallelly growing, we should stick to that number of 13 to 13.5.
Got it. The follow-up question is on the capex. I thought except you, we had enough capacity in the Rossari Biotech particularly. I think last time when we discussed, our utilization was about 55-60%. Any reason for suddenly expansion into the Rossari side?
So, Sanjay ji, our capacity is more on the formulation front, and whatever capacity we are adding is on the synthesis of the reaction front.
Okay, we are putting up the reactors now.
Yeah, reactors, yeah. So we are putting up all reactions and new, kind of chemistries which we are doing. Of course, catering to the same customers where our focus is on home and personal care. Oil and gas is one business which we look at scaling up. Pharma is one which we are trying to scale up.
Unit up, right? Oil and gas.
Rossari. So this year, last year we did not. If you see since IPO, we have not done any capex. So last year we did some I think 30 crores in a year Rossari mein, and we did in the MDA plant majorly in unit of. So this. क्या बोल रहे हैं संजय जी?
मैं बोल रहा हूँ कि उससे एक साल पहले we doubled the capacity, right? We added almost 1 lakh.
No. Last year we put 90 crores first time in 5 years in Unitop.
Okay, you're talking about Unitop. Sorry, I was confused.
Rossari we did only 30 crores last year. 5 साल में 30 crores का खाली हमने capex किया हुआ. वो last year किया तो.
So monomer, I thought we were doing only acrylic polymer. Now, have you added any other chemistry in the monomer side?
No. For example, in our capex, our ongoing capex, there are 2 parts which we are doing. One is in Rossari, I'm talking about now. One is we are doing the premix and the vitamin premix and the trace mineral premix. That continuous automation plant we are putting up. The second part which we are doing is the biosurfactant, which we see, Edward sir also spoke about the Renova platform. We are trying to add a big fermenter there and increase the production of our biosurfactants line. These are 2 areas, but we also are trying to increase our, backward integration for unit of raw materials, which include various esters, various phenols, and a lot of other products which go as raw material. And this could be, related to vegetable oils, related to various chemicals. It could also be hydrogenation. So these are all capacities which we are trying to put up so that we are a completely integrated unit and we earn the benefits in the year to come.
Got it. I just wanted to understand a little bit on this Renova platform. What exactly are we trying to do here? Is it the same surfactants which I thought we were using oleo, right? So it was naturally a green surfactant. So when we say Renova platform, what really the difference from that palm oil-based surfactants?
No. Palm oil-based surfactants are synthetic. Palm oil plus.
SLES and SLS. Correct.
We are not talking about those surfactants. I'm Edward here, incidentally.
Hi, sir.
And the Renova platform is basically for sophorolipids and other kinds of lipids that we are working on. So sophorolipids, we had I would say a small production plant, bigger than the pilot scale. And now we are adding more capacity because this has been successful and commercialized very successfully. So this platform is, we've over the year, we found that not only in personal care, but these sophorolipids now can be marketed to many other industries, including textiles, coating, animal health and nutrition, food, etc. So that made us go in for that expansion to manufacture the sophorolipids platform. Now, sophorolipids is manufactured from vegetable oils, and initially we started with a particular vegetable oil. Now, in the last 1 year, we have a platform where we can use various vegetable oils to produce a different qualities of sophorolipids.
Got it. And they find application as what is surfactant? They add more cleaning, or what is the characteristics which these lipids add to the product?
So the sophorolipids or these biosurfactants, they have the ability to enhance the application efficiency. Basically, they enhance the application efficiency. I mean to say normal surfactants, if you have to use say 1%, then this surfactant you have to use at like 50 ppm or 100 ppm. So they have very high efficiency to take the actives onto the substrate. So application efficiency increases considerably. Therefore, we found that if you add these along with other surfactants, especially in emulsification, in agro formulations, the stability and the amount of surfactant required, that all changes and gives you a much better product.
And these are biodegradable, hence it is biosurfactant, or we use lesser quantity, hence it is a biosurfactant?
No, completely biodegradable. It is based on vegetable oil.
Okay. It doesn't get into the chemical characteristics like SLES or an SLS?
No, different.
Very clear. And what will be the capacity utilization for us right now in Rossari, Unitech and TriStar?
So currently, on the ethoxylation side, we are completely utilized in unit of TriStar. And so overall, our capacity utilization, apart from that, would be in that range of 50 to 55% on the formulation side.
Got it. One last question. We are coming up with very large EO capacity starting to Q26. Have we ensured that we get enough raw material to run them full? How are the discussions for procurement of ethylene oxide?
For this year, the Reliance expansion is delayed a little, and we are expecting confirmation from Reliance for the new EO supply. But at the moment, we will, if there is a constraint on EO supply, we will give the EO to the maximum margin products rather than working on lower margins. So in any case, we should see a better profit amounts, EBITDA amount than last year, even if there is no additional EO available. But we are hopeful that we will have a little more EO available than last year.
That means the new plant cannot run, right? Because we don't have the raw material, and if we are talking of the same EO availability or a little bit better, that should suffice with the existing plant. What about this large new plants which are?
So now what we have is we have the MDA plant, we have the pharma, we have, products in ethoxylates for home personal care, for oil and gas, for agro. जहाँ ज़्यादा profit margin मिलेगा उधर हम लोग ये के product बनाएंगे. So we now have diversity in what we make and the flexibility to sell to customer who gives us a higher margin. So in all cases we should do better than last year.
The existing plant or not?
हाँ संजय जी.
मैं बोल रहा हूँ कि वो तो existing plant में भी हो सकता था ना. ये what is the?
नहीं.
This new plant will help us.
अभी जो expansion किया है संजय जी हम लोग ने वो continuous ethoxylation का expansion किया है जो अभी second quarter में हम लोग चालू करने वाले हैं. We did not have continuous ethoxylation, so we could add a lot of new chemistries, especially on amine, on gas sweetening agents, H2S scavengers. So these are lot of new possibilities which can come up with the same EO molecule.
So these plants will also enhance our capability to use EO in a much better way than what we were doing earlier.
Yes, the new plant is a continuous plant. So the continuous plant, of course, in terms of output would be much better than the batch plants. But in continuous plants, we require larger run products. In batch, you can take, even a 10 kilo, 20 kilo, 50 kilo batch. But in a continuous, we cannot take, smaller batches. So both have their pluses and minuses.
Got it.
We are also looking at derivatives of whatever we make in those continuous ethoxylation plants to make derivatives from that, Sanjay ji, which can give us higher margin products. So, for example, we make amine, for example, MDA amine or MEEE amine. These amines we can do further reactions and make some derivatives, and we are looking at those possibilities in our R&D setup.
Got it. Very clear. Thanks for answering all those questions patiently and.
Thank you, Sanjay. Thank you.
Thank you. Before we take the next question, we'd like to remind participants to press star and 1 to ask a question. We'll take our next question from the line of Darshil Zaveri from Crown Capital. Please go ahead. Darshil?
Hello. Good evening, company. Hopefully I'm audible, sir.
Yes, please go ahead.
Hello. Yeah. Hi, sir. So, sir, just wanted to know, a lot of my questions have already been answered. So, with regards to guidance that we are giving...
Sorry, you're sounding muffled. Can you use your handset mode?
Hello, is this better?
Little
Hello?
better. Yeah, please go ahead.
Yeah. Hi. So, just wanted to ask regarding the guidance that we are giving, like, I think overall company are expecting to mid-teens level. But...
I'm sorry, you're sounding muffled, Darshil.
Hello. Is this better? Hello?
Yeah, a little better.
Yeah. Hi. So just wanted to know, like, our Q4 run rate itself is around 580 crores, and if we annualize that, we should already be at mid-teens growth. So with the new capex, you should be aiming for higher growth, right?
No, we should not take the Q4 because there are, in some cases, Q1, Q2s are a stronger quarter with agro, happening in those quarters. Q3, Q4 are generally been a little slowish quarter. Of course, this year we broke that thought also. Yeah, that jinx also. But I think currently the way, as Mr. Chari just spoke about EO availability, etc., on an annualized basis, we would stick to that 15% kind of top line and growth. So that's what we are looking at sitting today.
Okay, fair enough. So if I could ask a bit about like FY27, both of our capexes would come online, right? At that point of time, what kind of growth we would see, and even like our B2C business, I think we should be EBITDA break-even by that time. So, at that time, margins also accretion could start, so the backward integration. So, maybe like FY26 we will be, finalizing, getting all the things together, and then FY27 can be a big bang year. Like, is that fair way that the company is looking at it?
Yes, I think that's what is our understanding. 27 should be a much better year, because by then the capex will be on stream. Hopefully the EO availability issues will also get resolved. The additional EO capacities will all come through. So if all these things fall in place, I think that should be a stronger year for us.
Oh, fair enough. So just like what is our maybe 5-year vision, like, or maybe a 3-year vision that we like, right? Like for next year, it's quite clear what we are seeing it, but maybe 2-3 years down the line, how are we seeing it? Like where do we want to stand at, sir?
At the moment, we have done some expansion last year, and we are planning some expansions this year. Now, looking at the global scenario, with the geographical war situations in India, subcontinent, but also China, Taiwan, and the Iran and the Ukraine, all these issues, we are still not certain with the tariffs. We are not still certain. So at the moment, we are not clear on what the future is. The skies are not clear, the path is not clear. We are not able to tell you, but based on what we have done till now, the consumer businesses should be profitable in 27. Our expansion should all be online. We should have higher EO availability. So 27 should be a very good year. That is what we can say. I cannot talk about 2028 this moment. If you had asked me 6 months back, it would have been different. But now it is. I'm completely clueless on what to do.
Fair enough, sir. Yeah, that's it from my side. So all the best. Thank you.
Thank you. Thank you, Ji.
Thank you. We'll take our next question from the line of Nitesh Dhoot from Anand Rathi. Please go ahead.
Hello. Good evening, team. Thanks for the opportunity. So my first question is on on acrylic acid. Just wanted to check on how much would be acrylic acid as as a percentage of our total input cost. Say how much was it for FY25?
Acrylic acid is a very small item. Ethylene oxide is our major item. But now we have a huge number of raw materials, which include vegetable oil. So it will be a very, very small percentage now. And now acrylic acid is available locally from Bharat Petroleum Corporation Limited from the Kochi refinery. So it is not so much of a worry. And because previously there was no manufacture of acrylic acid in India, now acrylic acid is only, practically everything is being sold by BPCL. Previous companies like LG, Sumitomo, and also the Chinese players were dumping, but now BPCL is very ably managing the situation, and imports are not coming now. Very little imports of acrylic acid is coming now into India.
Oh, okay. So you mean to say acrylic acid prices moved up around 10% sequentially, so that would not have any role in lifting your realizations possibly in Q4?
No. Now it is much lesser consumption of acrylic acid than in the past. So it doesn't affect so much. Of course, acrylic acid prices going up hit our gross margins, but it is not such a big hit what it was previously.
Understood. So just a couple of bookkeeping questions. So how much was the exports during Q4 FY25 and for the corresponding period last year?
So our Q4 exports was about 162 crores. And last year it was about 127 crores.
All right. And could you also share, maybe it wasn't clear in the previous participant's question, the standalone, the capacity utilization, numbers if we can share unit-wise for Q4 and for overall for FY25?
So I think I just talked about that. On the ethoxylation front, we are now almost at peak utilization. And on the formulation side, we are at about 50-55% kind of utilization.
All right. Okay. Thank you. Thank you so much. Thanks a lot.
Thank you. We'll take our next question from the line of Bhavin Soni from B&K Securities. Please go ahead.
Good evening, sir. Am I audible?
Yes, please go ahead.
Hi, I just wanted a clarity with respect to textile specialty chemicals. So you had highlighted in previous calls that you are targeting Bangladesh to become a 100 crore geography. So wanted to know the progress on that and how is it shaping up, and anything if you can highlight on the geopolitical issues also.
At the moment, for us, the Trump tariffs seem to be a blessing rather than a curse. The Trump tariffs is more on China, and it is even more on Thailand, Malaysia, and Indonesia. So for us, the area is Bangladesh. The major exports from Bangladesh was to Europe. So in terms of geopolitical issues now, I don't see any major setback to our exports or even domestic on all these issues.
So just to add to that, demand from Bangladesh is not that it's come down significantly. We have strong demand requirement, but we are being a little careful on what customers to work with, keeping in mind that they have issues on the foreign currency, etc. So we are going a little slow in Bangladesh, but I think seeing that the current issues in Bangladesh, we've also started looking at other geographies to grow our textile exports. So some of the countries in Southeast, also looking at Egypt and Turkey. So these are going to be some of the other key markets. Hopefully these will make up for any of the deficit which happens in Bangladesh, and maybe a little more than that. So we are keeping Bangladesh warm. We are still supplying material to Bangladesh, but to the customers of our choice.
Okay, thank you.
Thank you. We'll take our next question from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the follow-up. Just one question. What is the debt for FY26? I mean, year-end debt after all the capacity expansions are completed, and what is likely to be the cost of debt? Thank you.
So FY25 we were at about net debt of 70. So some of these new capexes will come up during the year. So I think we should be at a level of at least twice of what we currently are.
Okay, and the average cost of debt?
We are at about 8% kind of cost.
Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. As there are no further questions, I now hand over the call to management for closing comments. Over to you.
Yeah, thank you everyone. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR. Thank you once again for taking the time to join us on this call.
Thank you, members of the management team. On behalf of Rossari Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.